Welcome to another BAR walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over BAR Area 1. This is Section A1. This is an analysis topic. Interpret financial statement fluctuations and ratios, and that would be things like the profitability ratios, liquidity ratios, solvency ratios, and the performance ratios. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. Now, if you don't know much about our strategies, make sure you go to SuperfastCPA.com and sign up for our free 1-hour webinar training. In that 1 hour, we will teach you the key ingredients to passing the CPA exam so you don't waste months or even years of your time failing exams. So make sure you check out the webinar, and after you watch that, you're going to want to learn more, so make sure you also check out becoming a SuperfastCPA Pro member. Pro members get access to the full versions of these YouTube videos. So in today's video, we're only going to be going over 6 questions, but SuperfastCPA Pro members will get access to the full 12-question video when we post it in the member forum. So if you like this and you like our other videos for the other sections as well, make sure you check out becoming a SuperfastCPA Pro member. Now with all that, let's dive straight into the questions. All right, here we are at question 1, and something I always like to point out is a good strategy for especially test day, and that is reading the last sentence of the question first. There will be occasional times where it's not really necessary, but most of the time you want to be in this habit because it will give you context for what the question is about. It will immediately tell you this is probably what I need to be looking at throughout the rest of the question so that you can be thinking about it as you go. So let's go ahead and do that right now. Which of the following transactions would leave the current ratio unchanged but decrease the quick ratio? Okay, so if you remember what those are, that's good. Let's go ahead and go to the top. A company has the following current asset and liability balances before any of the transactions below. So current assets and current liabilities. Cash, $100,000. Accounts receivable, $50,000. Inventory, $150,000. And current liabilities, $100,000. So again, which of the following transactions in the options would leave the current ratio unchanged, but would decrease the quick ratio? Let's go through the options really quick. Option A, paying off $25,000 of accounts payable using cash. Option B, borrowing $50,000 cash through a long-term note payable. Option C, using $30,000 of cash to purchase inventory. Or option D, collecting $20,000 of accounts receivable in cash. So which one of these would not affect the current ratio but would reduce the quick ratio? If you remember what those are, that's great. You might already have an idea of what the correct answer is, but if not, that's okay. We are using these questions to learn this material. So let's go ahead and go to the explanation right now. All right, here we are. The answer is C, using $30,000 of cash to purchase inventory. That is going to not affect the current ratio, but it will reduce the quick ratio. So let's learn why. First off, as a reminder, the current ratio is just current assets divided by current liabilities. Pretty simple. The quick ratio is kind of a smaller version of the current ratio. It's cash plus accounts receivable plus marketable securities divided by the current liabilities. And if you notice, that's basically usually people think of it as just instead of current assets, it's the current assets less inventory. That's almost one of the easiest ways of thinking about it. Buying inventory with cash does not change the total current assets because cash goes down and that's a current asset, but inventory goes up the same amount and that's a current asset, so it stays the same. So the current ratio stays the same. For example, the current assets are $300,000 in this question, and the current liabilities are $100,000, so the current ratio would be 3, and it would stay 3. But inventory is excluded from the quick ratio, so cash, being a quick asset, is included in the quick ratio calculation, so you do reduce the current assets in the quick ratio when you use the cash, but inventory is not included. So the current liabilities stay the same while the current assets go down, making the quick ratio go down as well. And let's think about that. In this situation, there's $150,000 of current assets besides the inventory, and there's $100,000 of current liabilities. But if we reduce the cash by $30,000, that's going to bring it from $150,000 to $120,000, and that's going to be $120,000 over $100,000 of liabilities for the quick ratio, meaning that the quick ratio goes from 1.5 to 1.2. So we learned how to think through these different ratios right there. Now let's go to the next question. All right, here we are at question 2. Which of the following transactions would most likely increase working capital? Okay, hopefully you remember what working capital is, but if not, we're going to go over this. Let's go through the options. Option A, taking out a 3-year loan that requires equal principal payments over the next 3 years. Option B, refinancing $50,000 of accounts payable into a 5-year note payable. Option C, paying off accounts payable using cash. Or option D, purchasing equipment using a combination of cash and a short-term note payable. So which one of these would increase working capital? If you remember what working capital is, then you'll have an idea of what the correct answer is. But if not, that's okay. We're going to look at the answer together right now. All right, here we are. The answer is B, refinancing $50,000 of accounts payable into a 5-year note payable would increase working capital. So let's go through this. Working capital equals current assets less current liability. So it's similar to the current ratio, The current ratio is current assets divided by current liabilities, and working capital is current assets less current liabilities. And I think that you might even sometimes see that the current ratio is called the working capital ratio because, again, it's using the same things. But again, we're just focusing on working capital right now. So let's evaluate each of these different options. Option A, there's a 3-year loan with equal annual principal payments, and that increases current liabilities because 1/3 of the principal is due within 12 months, which reduces working capital. And so let's think about that. That increases the current liabilities each year. So current liabilities is going to be bigger in that situation rather than smaller, meaning that the working capital is going to be smaller. In option B, that's where they refinance accounts payable, which is a current liability, into a long-term note. So that removes it from current liabilities, meaning that current liabilities goes down, meaning that working capital goes up. Because if current liabilities is smaller, then current assets will be even bigger after subtracting current liabilities, and so that makes working capital bigger. Option C, paying off accounts payable with cash reduces both current assets and current liabilities by the same amount, so that has no effect on working capital. And then D, buying equipment with cash and a short-term note adds to current liabilities and reduces current assets. Working capital decreases from that. So you can see with the other options, they all either decrease working capital or don't do anything to working capital, but B is the only one that actually increases working capital. So we were able to see there in this question what different things might affect current assets and current liabilities that would in turn affect the working capital. Now with that, let's go to the next question. All right, here we are at question 3. What is the company's operating profit margin? Let's go up to the top. A company reports the following for the current year. They have a net income of $120,000, interest expense of $15,000, tax expense $5,000, sales revenue $400,000. So what's the operating profit margin? If you remember how to calculate operating profit, then you'll probably remember how to do operating profit margin. Based on this information, you should be able to do that if you, again, remember what operating profit is. If not, though, that's okay. We're going to go to the explanation right now. All right, here we are. The answer is A, 35%. That is the operating profit margin. Let's go through the explanation. Operating profit margin is calculated as operating profit, which is another way of saying EBIT, which is earnings before interest and taxes, and you divide that by sales. EBIT, as I said, stands for earnings before interest and taxes, so we add back interest and tax expense to net income to get EBIT. So if we have net income and we know the interest expense and we know the tax expense, we can add those back to net income and get ourselves back up to earnings before interest and taxes. So in this case, earnings before interest and taxes is $120,000. That's the net income, plus the $15,000 of interest, plus the $5,000 of taxes, and that gets us to $140,000 of earnings before interest and taxes. Then we can calculate the operating profit margin, and if you remember, operating profit is earnings before interest and taxes divided by sales. So $140,000 of EBIT divided by $400,000 of sales gives us 35%. That is the operating profit margin. This ratio tells us how much profit the company generates from its core operations before interest and taxes relative to its sales. A higher operating margin means better operational efficiency. So that means that the company is operating in their own regards more efficiently than if it was lower, because interest and taxes might not be as much about the operating efficiency and would be, kind of separate. So that's why you don't take them into account when it comes to doing the operating profit margin. So again, EBIT is operating profit. That's another word for it. And then you divide that by sales, and that gives you the operating profit margin. Now let's go to the next question. All right, here we are at question 4. What is the company's return on assets, and which combination of changes would most likely cause ROA or return on assets to increase in the future? Let's go up to the top. A company has the following financial data. They have net income of $40,000, sales revenue of $800,000, and average total assets of $500,000. So what is their current return on assets? And then what changes might cause it to go up even more in the future? So let's go through the options. Option A, 8% for the return on assets, and it would go up if you increased sales while keeping net income and assets constant. Option B, 5% return on assets, and that would go up if you increase total assets while keeping net income constant. Option C, 8% again, and ROA would go up if you increase net income without increasing total assets. And then option D was 12%, and it's saying that it would go up if you increase both net income and total assets by the same percentage. So which one of these is the correct actual percentage of return on assets, and which one of them is correct when it comes to saying what would most likely cause return on assets to go up? So if you know how to do this, that's great. If not, let's go ahead and take a look at the answer together. All right, here we are at the answer. C, 8%, and ROA would go up if you increase net income without increasing total assets. So let's go through this explanation to make sure you understand what's going on here. So ROA, or return on assets, is net income divided by average total assets. And so the current return on asset is $40,000 divided by $500,000, and that gives you 8%. So the current return on assets is 8%. Return on assets improves when net income grows faster than assets, or when assets stay flat and income rises. If net income rises to $50,000 while assets remain $500,000, the new ROA would be 10% higher than the present 8%. And that would make sense. You do 50,000 divided by 500,000, that gives you 10%. Option C describes that exactly. The other choices don't actually affect the return on assets, or they actually reduce it. And you could easily go see that if you wanted to calculate those. But again, the return on assets in this case is 8%, and it would go up if you increase net income without increasing net assets. Now with that, let's go to the next question. All right, here we are at question 5. What will the new cash conversion cycle be, and how will this change impact the company? Let's go up to the top. A company is analyzing its cash conversion cycle using the following information. Days sales outstanding, or DSO, is 45 days. Days inventory outstanding, or DIO, is 50 days. And days payables outstanding is DPO, 30 days. Management plans to reduce the DSO, so days sales outstanding, to 35 days instead of the 45 by improving customer collections. All other factors will remain the same. So with that, what will the new cash conversion cycle be, and how will this impact the company? So if you know what the cash conversion cycle is, then this question will be super easy. If you don't remember what it is though, that's the point of this question, is to remind you what the cash conversion cycle is and what that kind of means for the company. So pause the video if you want to think through this, or if you know the answer. And if not, let's go ahead and take a look at the answer together right now. All right, here we are. The answer is A, 55 days, the company will recover cash faster. So let's quickly go over this. The cash conversion cycle measures how long it takes from paying for inventory to collecting cash from customers. So spending money to then earn money, how long does that take? So the formula is DSO, that's days sales outstanding, plus DIO, which is days inventory outstanding, less DPO, which is days payables outstanding. So how long are the sales outstanding, plus how long is the inventory outstanding, less how long are they owing money, how long are the payables outstanding. So original 45 days plus 50 days less 30 gives you 65 days. But now with the new days sales outstanding of 35 instead of 45, it goes down to 55 days. So their cycle drops from 65 days to 55 days, which again, that's about 55 days of a cycle from buying something with cash to then getting money from selling that thing that you bought with cash. And that means that, again, the company recovers cash 10 days faster each cycle. And if you have multiple cycles like that, you're collecting significantly more cash throughout the year than if it was 65 days. So we learned a little bit about the cash conversion cycle there. Now let's go to the next question. All right, here we are at question 6. What is the most accurate description of the effect on the debt to assets ratio? Let's go up to the top. A company has total liabilities of $1,800,000 and total assets of $3,200,000, resulting in a debt to assets ratio of approximately 56%. The company then borrows $200,000 in cash using a long-term note payable. So what is the most accurate description of the effect on the debt to assets ratio from them borrowing more cash by using a long-term note payable? So let's go through the options. Option A, it will significantly decrease because long-term debt reduces short-term risk. Option B, it will decrease because assets increase by more than liabilities. Option C, it will stay the same because both amounts increased equally. Or option D, it will increase slightly because liabilities increase more proportionally than assets. So pause the video, think about this. If you understand what the debt to assets ratio is, it's pretty straightforward. I think you can easily figure out or remember what it is. And then read through these options again on your own. And when you're ready, come back, we'll look at the answer together. All right, here we are at the answer. D, it will increase slightly because liabilities increase more proportionally than assets. So let's go through this to kind of see how the numbers work out. The original ratio was $1,800,000 divided by $3,200,000, and that gives you 0.5625 or 56.25%. Now, if the liabilities go up by $200,000 and the assets go up by $200,000, that makes it instead $2 million divided by $3,400,000. And that actually gives you 0.588 or 58.8%. So even though they went up the same dollar amount, because the proportions are different compared to the whole, that does not mean that it's going to stay the same. It actually means that it's definitely going to change. Even though the same dollar amount was added to both liabilities and assets, the increase in liabilities is proportionally larger, which causes the debt to assets ratio to rise slightly. And again, that's because liabilities was smaller originally, and adding $200,000 to it makes it bigger proportionally than if you add $200,000 to the assets, which were larger at $3,200,000. So the correct answer here was, again, D. And with that, we've learned quite a bit about financial statement analysis and ratios throughout these 6 questions. Now, before we do anything else, let's do one more part of the SuperFast CPA process called Pillar Topics. Now, the idea behind Pillar Topics is as you're going through the questions to learn the material, you will notice the things that keep popping up. You've seen 2 or 3 or 4 questions trying to teach you about the debt to assets ratio or the current ratio or analyzing some kind of other ratio. Again, you are seeing these things pop up in the questions, and so you take a moment to write out the most important things you learned in your own words. And as you're doing this each day, you are building your own personal repository of the Pillar Topics so that you know what is important for exam day so that you're ready when you get to the test. So let's go ahead and take a look at the Pillar Topics for this video. All right, here we are at the pillar topics. Let's just dive straight in. First off, the current ratio includes all current assets, while the quick ratio excludes inventory. Again, that's kind of the easiest way to think about it. So trading cash for inventory leaves the current ratio unchanged, but lowers the quick ratio because, again, inventory is not included in the quick ratio. Now let's talk about working capital. Working capital increases when current liabilities are reduced because remember, working capital is current assets less current liabilities. And so it would be increased if current liabilities are reduced, such as by refinancing short-term debt into long-term debt or using a loan with a delayed principal payment. Now let's talk about operating profit margin, and that's calculated by dividing EBIT, which is just net income plus interest plus taxes, it's earnings before interest and taxes, by sales and reflects how efficiently a company generates profit from operations. Now let's talk about return on assets. Return on assets improves when net income grows faster than average total assets or when assets remain flat and income increases. Now let's talk about the cash conversion cycle. That one was where, you take the days sales outstanding plus the days inventory outstanding less the days payables outstanding. And depending on those numbers changing, the cash conversion cycle might change. It shortens when collections speed up or inventory turnover improves. So if you have inventory going through faster or if you're getting money paid more quickly, that's going to improve the cash conversion cycle, and that would reduce the time it takes to convert outflows of cash to inflows of cash. And then finally, let's talk about solvency ratios kind of in general. This is what we covered in question 6. Solvency ratios like debt to assets and times interest earned show long-term financial stability. Borrowing increases the debt ratio if liabilities rise faster than assets, while a higher times interest earned means better interest coverage. And by the way, that times interest earned one is one that we're going to be covering a little bit more in depth for the member version of this video. So as a reminder, as we end this video, this YouTube version only had 6 questions, but SuperfastCPA CPA Pro members are going to get access to the full 12-question version of the video when we post it in the member forum so that they can get a little bit more help and a little bit more understanding. So if you like this and you like our videos for the other sections as well, make sure you check out becoming a SuperfastCPA Pro member to get access to those full videos. And the easiest way to actually become a SuperfastCPA Pro member is by going to SuperfastCPA.com and signing up for our free 1-hour webinar training. In that 1 hour, we will teach you the key ingredients to passing the CPA exam. And after that, you'll have a much better path to knowing how to and to becoming a SuperfastCPA Pro member. So check out the webinar, then check out becoming a pro member. With all that, I hope this video was helpful. If you did like it, make sure to like it and leave a comment, and I will see you in the next video.